Welcome back to another episode of Not Financial Advice. This is Sean, and today we're going to be talking small caps. So, if you're like me, whether you've been investing for decades or you're just putting together your first portfolio after such a great year in 2023, the question is what is the right way to be positioned in the stock market for 2024? And so, all of the talking heads on TV have thrown out all sorts of different ideas, from staying with the Magnificent Seven to going to financials, industrials, small caps, bonds, communications, and more. So everyone's all over the place. But today we're going to be taking a look at some words of wisdom from Tom Lee right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
All right, guys, I'm going to ask you to hit the like button and subscribe to my channel if you haven't already, and we're going to get right into it because we have a lot to cover today. Right off the bat, we are filming. It is the 22nd of December, and we have just a handful of moments until the market closes. So I figured I might as well just do a really fast update on my portfolio. Looks like I am up 0.53% today. Which is good for about $355 in gains. The S&P 500 is up 0.14% today. And of note, the Russell 2000 index is up 0.81% today. So I'm kind of smack dab in the middle between the large cap index and the small cap index. That's just sort of how my portfolio is set up. So I'm pretty pleased with that, but that brings us back to the topic of today's video, which is small caps, their role in a diversified portfolio, the history of small caps as it pertains to rate cuts, and some of the predictions that Tom Lee, among others, have made about the future performance of small caps. And so, this is not a channel where we are day traders or swing traders. Everything that I hold or that I am going to be talking about, which might set me aside from some other financial YouTubers, is about a long-term value-based buy and hold strategy. At the same time, I do think there's a role within such a strategy for sort of midterm or 3 to 5 year investments. But, I would just caution that some of the things we're going to be talking about today can be volatile. And it's a cliche, but sometimes with more risk, there is a higher reward. Um, I'm going to have you like the video and subscribe to the channel, whose name is Not Financial Advice. And I gave it that cute name because I didn't want to leave that really cringy disclaimer at the beginning and end of every video that I make. But I will say that what I'm going to be talking about isn't financial advice. Tom Lee is not giving you financial advice. But we are going to be providing you with some fantastic education and hopefully a little bit of entertainment along the way. So let's jump right into it. So the question is, in 2023, the S&P 500 looks like it's going to be closing up around 25%, which is fantastic. And in the last month, we've seen a really nice Santa Claus rally here of around 4%. So it'll probably close between 4 and 5%, give or take, in the last month of the year, which is a fantastic Santa Claus rally. As we're looking at how the broad market is done in the last month, it's up 4%. So the topic of today's discussion is the small cap section of the U.S. stock market. And so you see a lot of deviation here. U.S. market, S&P 500 up 4%, and the Russell 2000, which is the 2000 of the smaller stocks in the U.S. stock market. So there's 3,500 stocks that trade publicly in the United States. The S&P 500 is the top 500 by position size, and the Russell 2000 is the smallest 2000. And so in the middle of those 1,000 are going to be some smaller mid caps and some larger mid caps and some smaller large caps or something like that. But as we're looking here at the performance of the Russell 2000, we can see that it's up 13% in the last month, which is crazy. So as I mentioned in my last video, the Russell 2000 has gone from a 52-week low to a 52-week high within 8 weeks. And that's why we don't time the market. That's why, as I talked about earlier, we are long term buy and hold investors. But with that being said, the Russell 2000, or the basket of small stocks, here in the United States, has underperformed the S&P 500. As we saw just moments ago, the S&P 500 is up around 24%, whereas the Russell 2000 is up only 15.5% in the last year. But we can get a better picture of that when we look at the performance of the Russell 2000 versus the S&P 500 over the last 5 years. So over the last 5 years, the Russell 2000 has returned, a respectable 10.25% a year, whereas over the last 5 years in the S&P 500, we've had almost double that performance. So 15, 16% or something of that nature every year. So significant outperformance on large cap stocks over the last 5 years. And that's not just the case over the last 5 years, that's the case over the last 12 or so plus years. And so we've been living in a world where large cap US stocks have led the world's market. But there have been times when smaller stocks have held leadership. And it's not just for a year or a few quarters. There's been a whole decade actually where small caps outperformed. And so we're going to take a second and we're just going to get in here and we're going to see some remarks from Tom Lee. In the remarks, it'll just be about a minute and a half, but I'm going to show you who he is, what he has to say, why you should be listening to him. And then we're going to go ahead and we're going to dive into the research that I put together for you here last night. So hang tight, like the video, subscribe to the channel, and here is Mr. Lee.
I was just looking back at your call for 2023, and you had a target of 4750 on the S&P, and you nailed it.
A belief that the probability favored market breadth expansion, then you got to be overweight small cap stocks. So small caps are number one sector pick next year. On a price to book basis, small caps have never been cheaper than the S&P. And it's only been once in 1999. And that was the start of a 12-year period where small caps outperformed the S&P. So I think we're at the right launching point for small caps to have a huge year. That's why it's our number one pick. Well, I think for small caps, it'll be fine because I think small caps could be up as much as 50% next year. I think that small caps could actually just rally through this whole period too. So it might just be best place to be in the first half is small caps.
He nailed his prediction for the 2023 stock market all the way back in late 2022. So he nailed it on the nose. But not only that, he has a list of stocks through one of his firms that he publishes on a yearly basis that has outperformed the market every year for the last 5 years. And so that's getting him into that top, 2% of investors whatsoever. And so it would be disrespectful to call him a talking head. He's somewhere between a personality on financial news and Warren Buffett, somewhere right in the middle, which affords him a lot of respect. But enough about that. So here's the information that I've put together for you. And it was some painstaking research, so you didn't have to do it. But I think that we'll find this to be very interesting. So what we have here is a back-tested set of index funds or ETFs. And so I've back-tested from year-to-date 2003 all the way back till January of 1999, 3 or 4 different small cap strategies or mid cap strategies. That is where a lot of talking heads, those worth their salt and not, where they're saying they see some outperformance in 2024. And it makes sense to me if you consider what Tom had to say, and you'll see the the message that he has about small cap stocks on the way out. I think that, I've owned small caps because we know that um, from the year 2000 till the year 2010, the US stock market returned about 1% a year, whereas small cap stocks returned about 6 or 7% a year. You can take my word for it or double check me if you like. I'll leave a link to the software that I use to do this back testing, which is called Portfolio Visualizer. I'll leave that in the description below. If you have any questions about that, just let me know. But we've known, in my lifetime, small caps have returned 6 or so% a year over a decade from 2000 to 2010. Well, US large caps did nothing, did 1% a year, which is less than inflation. And so what I've done is I've back tested the index fund or mutual fund version of some very popular small and mid cap ETFs. So what we're going to be looking at is the performance of 4 or 5 ETFs here. So we're looking at VB, which is Vanguard's small cap blend ETF. We're also going to be looking at VBR, which is Vanguard's small cap value ETF. Additionally, we're looking at Vanguard VO, their mid cap blend. And then lastly, we're going to be examining VXF, which is the 3,000 stocks in the US market minus the S&P 500. So from mid cap growth to small cap value, tilting more so towards a mid cap growth fund. That's what VXF is. It's called the Market Completion Index or something along those lines. So we're looking at a blend of strategies and how they've performed since 1999, but more specifically and of more interest to us, we're looking at the returns of these funds not only overall, which we can see their performance here overall, nothing remarkable. VB has returned 8.5% a year. VBR has returned 9% a year. VO has returned 9.4% a year. The VXF Market Completion Fund has returned 7.9% a year to the market's 7.3. So nothing remarkable on a several decade long basis. But what I've done here, I'm going to go ahead and just sort of highlight this to you here. What I've done is I've labeled the years based on what was going on, not only in the economy, so whether we had a normal economy or an economy in recession, but I've also delineated bear markets. When bear markets and recessions have coincided, when we've had just bear markets, or a year with a bear market and recession plus recovery. And so they're color coded here. And I'm dancing my cursor around it to better enable you to follow along with what I have to show you. But you can see these different years here. And the reason that's important is, as we know, a few days ago, Jerome Powell mentioned that the Federal Reserve anticipates cutting rates 3 times in 2024. And we have to understand that that is part of, I believe in my interpretation, part of where Tom Lee is coming from in looking for outperformance for small caps. So remind me in 365 days, we can come back and see how this did. I won't delete the video if he was wrong and I highlighted that, but if I'm right, I will repost it. Yeah, probably. So like the video and subscribe to the channel so you can look forward to that. But getting into it straight away, what we can see here is back in 1999 was a normal year in America, good economy, good stock market. But then in 2000, we had the tech bubble collapse, and this was called the dot bomb recession in the United States, which lasted from 2001 or 2000 sort of through 2002. Okay, so the dot com crash and 9/11. And so what happened at that point, as you can see here, is that the Federal Reserve started cutting rates big league. And then additionally, they did subsequent rate cuts in 2002 and 2003. As you can see there in column A, row 6. And so what I've done is I've gone ahead and I've highlighted the years. So 2003 and 2004 were the years of a market and economy in recovery, which in my estimation was the period of time that the stimulating effects of rate cuts onto the US economy and market from the Fed had time to take effect. And so you can see, we had the S&P 500 had some rough times along with the economy in 2000, 2001, and 2002. Those rate cuts came to save the day, and we can see now here a market in recovery. S&P up 29% in that first recovery year and 11% in that subsequent recovery year. And so that's pretty good, but let's take a look and see how the blended small cap fund performed during those years. So in 2003, Vanguard small cap blend returned closer to 46%. Okay. And that's just what gives a little bit of this foundation for the type of call that Tom Lee is making. All right. And then if we look below here, we can see that in that second year, Vanguard small cap returned 19%. Okay. So what I've done for your convenience is I averaged Vanguard small cap ETFs overall performance in the 2003 and 4 recovery. And so we see that this fund returned 33% per year in those 2 years, whereas the market returned only 20%. So dramatic outperformance. And when I saw the pattern, I just had to bring this to you. So if you're getting value from this video, I'll ask you to like and subscribe onto it, and we're going to continue right along. So as I've sort of explained the methodology here, I'm not going to go in as much granular detail, but I'm just going to run through this on a bullet point basis, making sure that my regular viewer is able to keep up with this crazy red string spreadsheet with math numbers flying through there. I'm just going to make sure that it makes sense, but I think that I've sort of broken down how I've curated this data for you. So we're going to go a little bit faster. And then after we go down through the list of the performance of these small cap strategies after rate cuts, we're going to hear another word from Tom Lee, and then we're going to wrap up. So what we see here is that the small cap value strategy in this first recovery period, returned 30% to the market's 20%. Additionally, Vanguard's mid cap blend, VO, it returned 27% in the recovery after the dot bomb recession. Returned 27%, the mid cap blend, to the market's 20%. So 7% outperformance. The extended market, VXF, a really interesting fund, VXF returned 31% in the dot bomb recovery to the market's 20%. So now what we can see here is we remember that there was a recession based on global financial crisis and subprime mortgage crash of the housing market and the entire U.S. economy from 2007 through 2009 or so. And so we had massive Fed rate cuts in 2007 and 2008. The market had a hard time, 5%, which is a substandard year in 2007, and then down 37% in 2008. But the market was able to catch up after that stimulation from Fed rate cuts. And so we look at the global financial crisis, recession, and bear markets as their primary recovery period being 2009 and 2010. What we can see, the U.S. stock market returned on average 21% in the recovery years from the global financial crisis, but Vanguard small cap value, 32% over 21%. Vanguard small value, 28% to the market's 21% in the 2-year recovery period after 2008. Vanguard VO mid-cap blend returning 33% to the market's 21%. And Vanguard Extended Market returning 32% to the market's 20%. So are we starting to see a trend here after rate cuts happening? Now, I will say before we look at this last segment, we were overdue for a recession in 2020, but 2020 was a black swan event. The Fed cut rates. They didn't cut rates because the economy was stagnant. The Fed cut rates because the economy was non-existent when people felt as if or couldn't leave their house. They had to stimulate the economy. Usually the Fed is going to cut rates to stimulate the economy. In this case, the Fed cut rates to defibrillate the US economy and market. And so I'm not making the assumption that this rate and then again, we had in 2022 and 23, they were raising rates, right? Because they had to take some of that money back out of the economy, essentially from the stimulus checks. So I'm not saying that this anticipated 2024 rate cut cycle, I'm not saying that it's the same as 2008 and 2000 because it was under different circumstances. But I suppose that Tom Lee is from listening to his words. And so we see a little bit of a more muted response here. But in the recovery years from 2018, and that was where the Fed did some rate hikes, and that sort of made the economy a little topsy turvy. So I looked at 2019, 2020, and 2021 as sort of a recovery from a little bit of a rough patch in the market, some different rate hikes and cuts that were going on. It does get confusing, to be honest, but really this is surrounding 2020 and the COVID pandemic. And so what we saw is after these slight rate cuts in 2019 and big rate cuts in 2020, what we saw is that the US market returned on average over those 3 years 26%. And essentially, these other strategies actually did not do as well. Now, at the same time, that may be an indication that this time will be a mean reversion. When we see rate cuts in 2024, which would be right here, because we saw a different response here, we may have a more familiar response as we've seen here and here. But regardless, where we're going to leave this off at is that I've gone ahead and I've tabulated how the small and mid cap market, different strategies, how they have responded to rate cuts. And so what we're seeing here now is an average of the dot bomb crash, of the global financial and housing crisis crash, as well as the COVID crash. I've gone ahead and I've averaged out the performance of these smaller strategies over those three rate cutting cycles, which we're looking forward to in 2024. And here's the overall performance. So in first place, the benchmark here is that in the rate cutting cycles, the market has averaged 22.1% in those time periods I've described. The first place, as far as higher returns, is a pretty nice 29.2% for the extended market. In second place is going to be the small cap blend VB. In third place is Vanguard's mid cap blend VO, so at 28.4 versus the market's 22.1. And then we had some notable outperformance throughout all of these periods with VBR small cap value, which was 25.6. And so I'm a small cap value type of guy because I think it's sort of timeless on a long horizon there. But let's zoom back out, listen to some more words from Tom Lee so we can make sure to have the right context from an actual professional to bookend this session that we've just had together. And then we will wind out the video. Hang tight. Here's Tom.
I used to be a small cap strategist. The Russell 2000 historically only has, I think, 70% of its companies profitable. So it's the way these indices, the Russell's constructed, is just basically market cap size, but it's not a problem that there's that many non-profitable companies, because that's the history of the index. What really matters to small caps is, I would say, macro factors. Like, one, you need retail inflows. If people are taking money out of the stock market, they're not putting money into any Russell 2000 small cap index. So that's why you've had such a drainage out of small cap and a collapse in valuation. Price to book, again, is where it was in 99 versus large cap, and that was the bottom. The second is, small cap companies tend to have higher cost of money and are generally more levered. So this tight money has just punished small cap businesses, and that's kind of reversing. And then, of course, soft landing isn't a great scenario for small caps, but if we're entering expansion, right, economic momentum's been slowing for 3 years. If it starts to stabilize or improve, that's a huge tailwind for small caps. So I think they need to really study history.
All right, folks, if you're still with me, the market has concluded its trading for the day while recording this video, and the S&P 500 ended up 0.23% here, December 22 of 2023.